Hey there and welcome to the channel. In today's video, I want to go over my highlights for the Fundsmith Annual Letters to Shareholders, which is written by Terry Smith. Now, full disclosure, I am an investor in the fund and have been since 2021, but I look at my investment in the fund as an investment in any other stock, but instead of selling products or services, the company invests in other companies. Terry is, in my opinion, one of the best investors in the world, and I've read his books and letters to shareholders and watched all of his videos on YouTube, and I would recommend that you do the same if you are serious about learning how to invest. Let's get started, and the first thing in the letter is the performance for 2023, which unfortunately was only 12% compared to 16% for equities in general. And that is the second year that Terry is underperforming equities. But last year he did something like a negative 22% against negative 17% for equities in general. But like always, we have to zoom out and look at the long-term performance. And Terry has done 15% annualized against 11%, which is almost 4% outperformance a year since the inception back in 2010, which is pretty impressive. And these are the bottom 5 detractors for the fund in 2023. Those were Estee Lauder, McCormick, Diageo, Mater Toledo, and Brown-Forman. And Terry ended up selling their stake in Estee Lauder, where he was unhappy of the mishandling of demand and supply situation in China after the COVID reopening. And these were the 5 top contributors to the fund performance in 2023. The companies were Meta Platforms, Microsoft, Novo Nordisk, L'Oreal, and IDEX Laboratories. I personally own a stake in my portfolio in Meta, but I've never owned a stake in the other 4 companies. And Terry mentions here that Meta is making its 3rd appearance in the list of top contributors, while Microsoft is making its 8th appearance, where he was heavily criticized at the time for buying Microsoft back in 2011 at $25 per share, and now the price is around $350 per share. So a home run there for Terry. Now, as you might know, Novo Nordisk has been super popular in the markets in 2023 with their weight loss drug Wegovy, also known as Ozempic, when it's sold for treating diabetes. But Fundsmith has been a long-term investor where Novo is making its 4th appearance in the top 5. And Terry also mentions here L'Oreal, who has handled the China market situation much better than their competitor Estee Lauder, and also IDEX, which is a supplier of veterinary diagnostic equipment, but they are making their 5th appearance in the top 5. So if you've studied Terry Smith before, you can see he's pretty consistent. He's always talking about the same things. And he has a very simple 3-step investment strategy where he's buying good companies, he doesn't overpay, and then he does nothing, which sounds like a great plan, but it's easier said than done. So with the buying good companies part, he presents this table to investors, which are his key ratios. And the first ratio we're going to take a look at is ROCE, which is return on capital employed, which has improved from 27% back in 2016 to 32% in 2023. Now that's compared to an average of 18% for the S&P 500 and 17% for the FTSE 100, which is the 100 largest companies in the UK, but Terry is based out of the UK. Then you have gross margin, which is obviously very important, which has gone from 62% up to 63%, compared to the average of 45% for the S&P and 41% for the FTSE 100. Then you have operating margin, which has gone from 26% up to 29%, compared to the average of 16% and 15%. Then you have cash conversion, which has actually gone down from 99% in 2016 to 91% in 2023. But that's compared to 76% and 85% for the S&P and FTSE. But as you can see here, cash conversion is comparing free cash flow per share with the net income per share. and that is to see if the company is delivering high quality earnings, if the earnings are getting turned into cash, and you want to have that percentage at 100 or above, which means that most or all of the earnings are getting turned into cash, which is positive for the company. Now, finally, he has interest cover, which has gone from 17 times to 20 times, compared to 11 and 10 times for the FTSE. Now, the next thing he measures is the weighted average free cash flow growth, where it is the cash that the company generates after paying for everything except the dividend. And that grew by 14% in 2023, which is pretty healthy. And Terry also likes the fact that the average year of foundation for the portfolio companies is 1916. So he wants the companies to be pretty old and established. Now, the second leg of the strategy is about valuation. You obviously don't want to pay too much, but you also want to be ready to pay up for high quality. So the average weighted free cash flow yield for his portfolio companies started the year at 3.2% and ended at 3%, and that's compared to the free cash flow yield for the S&P 500 of 3.7%. Now, some of you have maybe seen my video on my personal portfolio, but I just wanted to quickly show you the key ratios that I measure for my portfolio and compare that to Terry's. Now, the first thing is free cash flow yield, and his weighted average was 3 minus 7. Interest coverage was about 20 minus 65. Operating margin for me is 30. His was in the high 20s, and gross margin was high 60s for him, minus 70. He had an average return on capital employed of 32 and minus 25. Then he's also tracking the free cash flow growth for his companies, which was 14% for 2023, but mine was 47. So quite a difference there. Now, the third leg of his strategy is to do nothing to minimize cost in buying and selling stocks. And the portfolio turnover for 2023 was a little bit more than usual at 11%. Now, Terry sold Fundsmith's stake in Adobe, Amazon, and Estee Lauder, and purchased stake in Procter & Gamble, Marriott, and Fortinet. Now, I can understand why he sold out of Adobe. He was unhappy with the Figma acquisition, which they have now backed away from, but I can understand his reasoning on that. I can also understand why he sold Amazon, since I don't think Amazon was a company that fitted his criteria in the first place, and he has already explained why he sold out of Estee Lauder. Now, the investment in Procter and Gamble I couldn't understand, or for that matter in Marriott, but Fortinet is a company that seems to fit his criteria perfectly. Now, his small fund, Smithson, has already been invested in Fortinet for some time, and I wouldn't be surprised to see Fortinet having a higher allocation in the big portfolio when we see the 13F come out in February or March. But Terry really is a long-term investor where he has held 10 of the portfolio companies for more than 10 years, and 5 of those companies he has held since inception of the fund back in 2010. Now, Terry ends the letter by mentioning the second event worthy of mention is the passing of Charlie Munger, and he quotes Charlie Munger where he says, "If you're not a little confused about what's going on, you don't understand it," which is like everything that Charlie says was right on the money. But to summarize this letter, I am quite happy with the performance of Fundsmith, although they've been underperforming for 2 years. I do believe that Terry will continue to outperform the market since he is a much better investor and, in my opinion, one of the top 5 investors in the world. I will continue to hold my stake in the fund, but I'm not expecting 15% return for the next couple of years, but I do expect the fund to outperform. Terry is now managing around $30 billion, so it's going to be tougher for him to outperform in the coming years. But that's it for the video today. I do want to ask you to like and subscribe to the channel if you haven't already. I want to thank you for watching, and I will catch you on the next one.